Doing well. So, Sid, I'm going to just introduce, obviously, with a little bit of background. Oh, sorry, we already have people. Okay.
So yeah. Hi everyone. For those who joined the session, welcome. Uh, we're going to give it like 1 or 2 more minutes for other participants to join. And then my name is Mansi. I'm from the PwC team. We help manage the Uday platform. We will then kick it off. All right. I think I'm going to start off at least with the introduction, and then Sid will be taking over in a minute or two. So, thank you to the participants who have joined. Good afternoon to everyone, and welcome to the 22nd edition, and probably the last one for the year. I think this will be the last for the current year of the Uday Knowledge Sessions, which are brought to you by Mumbai FinTech Hub and PwC. For those who are new to this, the Mumbai FinTech Hub is the FinTech vertical of Government of Maharashtra, and they focus on the growth of FinTech sector in the state. And one of their key focus is building FinTech talent through education. So the education platform that we run is called Uday. Uday it focuses on assisting students like you all who are interested in pursuing careers in fintech, and we equip and it helps to equip you with relevant knowledge and information that you need to explore this kind of a career or any questions you have. A part of that program, one of the sessions we came up with was an Uday knowledge session where we specifically focused on providing you with fintech knowledge related to the basics of different fintech sectors and concepts. We have been inviting different fintech industry players, leaders, to come in here and providing their perspectives. We've covered various topics. For today's topic, we are very excited to have Mr. Sid Gandhi with us. Sid has over 15 years of experience in strategy, project, and program leadership, business development, payment systems, financial services, alternate financial service models, digital marketing, product development, and commercialization in the banking and finance domain. He, of course, has a special focus in the area of technology and payments, and he's the founder at Kye Pot. And prior to Kye Pot, Sid had worked in UK with Visa in Europe and Bank of America, Merrill Lynch, among other places. So today, just we are going to keep this session interactive. Sid is going to take us through the core concept, which is related to the emergence of social lending model in India, the chit fund model, where Kye Pot is, in, and it's very exciting, very different for us to hear how a chit fund model can actually benefit all of us if we would want to choose to go via that route. We had connected with Sid, last month on another initiative for MSME lending to understand how the innovation that comes with so chit fund model in helping lend to MSMEs, the really small MSMEs, the Kirana stores, etc. So very excited to hear from you, Sid. And after the session, and we also have taken a lot of questions from the students that we have received, but we will then address some of these questions that were sent at the time of registration, and we will open the session to you to ask questions using the chat functionality. I think through the session, if you have questions, please feel free to use the chat functionality to post your questions. And just a quick housekeeping: keep yourself mute throughout the sessions. I think we all are used to this now, given the amount of online sessions we attend. And yeah, without any further ado, I would like to hand over to Sid. Unless anyone has any questions, Sid can take over.
Hi, Mansi. Thank you for the introduction.
Yeah.
If you can, make me the presenter. I'll share my screen.
Yeah, I've passed it on to you.
Yeah, you have the ball.
Okay. Can you see my screen?
Yes.
And can you hear me?
Yes, we can.
Okay, fantastic. So first of all, thanks for inviting me for this session. Really excited to share what I know, what I've learned, what I've understood, throughout my working experience, and also very excited that it's being heard by the students. I'm hoping that I'm able to meet the expectations of explaining what people have joined here to hear. And you covered that my introduction part, so I'll skip that part anyways. And the topic that when we chatted, what you wanted me to present was the social finance. So that's the sort of focus of today for me is. And what I will do is I'll just start with giving a little bit of background or the history, or this might be cliche for everyone, but just to set the context of why is it that what we are looking at is slightly more social than the usual social that is probably in place. So since the early times, one of the oldest trade has been in exchanging money, or actually lending money. And how it all started was actually through the barter system. And this is how the trade used to happen. People used to exchange what they had with what they wanted. Somebody had to give, somebody had to take. And gradually, when the money got invented, it started to become more formal because the store value or the unit value of many things started to get attributed to a currency. And then sort of it started getting formalized in group finance, or people getting together through a trade associations, trade bodies, guilds, etc. And those were the early form of financial services. And it's definitely I'm not measuring the sort of time span here, but it is just to set the context that most of the predated financial services used to be very, very social, used to be very much based on trust and relationship. And whether it was individual to individual, or whether it was groups, or whether it was cohesive communities, or kingdoms, or countries, whatever they got formed. And what we have now is a very modern banking system, which is very much controlled by the sovereigns, central banks, very much formally. And this is something that has been sort of in place for the last 300 odd years. And for everyone in the on the other side listening, so what you probably are sort of about to sort of finish your studies, but the financial services, as you know or you have experienced, is very much formal banking asset classes, which is either a savings bank account or a recurring deposit, for a savings type of product, which is controlled by a bank, very formally regulated, and then numerous other types of asset classes which are around the investment space. whether it's mutual funds, stock-based investment, or any other derivative, which is a combination of debt and equity, which sort of gives you returns where you have to invest either one time or regularly. And on the other side, or the flip side of whatever gets stored, either in the form of people investing either in a bank or some other asset class, is actually then taken out and used as a borrowing in many different ways. And this is how the modern ecosystem of financial services actually works. So I don't want to labor it too much on it. I'm pretty sure everyone sort of sees it from their own perspective. But just to sort of see have a segue into what we are doing. So all the financial services, which is sort of predating the modern financial services, was always based on groups and people and social and the trust. And that is how there was a form of community banking or a community social services or social financial services that has always been in place. In fact, in India, whatever we know now or hear as chit funds is something that originated in the 12th century actually in India, and it got it got exported all around the world, which I'll show you how. But the groups, the people coming together, pooling in their resources, and the ones that they don't need the resources want to get some return by lending it to others who need the money, is just a social form of financial services. And that is what the current format of group savings or chit funds in India and across the world also still operate like that. So I will also go into a little bit of detail about the regulatory framework around that. But when we talk about the financial services, the modern financial services is very, very heavily regulated, and it is regulated by different types of regulators in India. Uh, and there are multiple types of institutions that can actually have your money saved or invested. There are multiple types of RBI banking licenses. There are multiple types of NBFC licenses as well. There are at least actually 12 to 13 types of different types of NBFCs. Very, very structurally, very, very different as well. So the modern financial services is very heavily regulated. And in fact, when I will describe the area that we operate, that is also very, very heavily regulated. And this is just to make sure that everyone is protected. The participants of the ecosystem are protected in every way, and there should not be any system issues or systemic issues. So sort of moving forward, from the what the group savings are. Actually, it got exported to the world, and definitely there was an influence from India. But actually, in this format of group savings or social savings and borrowing, which is done informally outside a banking ecosystem, is pretty common across the world. And if you try to see, the red spots here, what you will mostly try to think is, oh, these are probably majoritarily the emerging world, or the emerging economy, or probably not the most developed economies of the world. So what it means is that this sort of financial services still is quite predominant in those countries which are sort of not very, very developed, and still a lot of financial services or the banking is actually done informally. So which is why one of these famous guys who started Microsoft once said, and it has become a very famous quote, that banking is necessary, banks are not. So, which is why the entire world does something or the other, which is probably outside the formally regulated financial services, to fend for themselves, either to invest or to borrow. And that is also because traditionally the formal financial services has evolved in such a way that they have actually not been able to address the needs of the entire population. And financial services is the basic thing that that is required. So I'll make a little bit progress and just do a little, introduction of what we do. Now that I've given you my perspective of the evolution of sort of social financial services, also how the landscape of the formal financial services looks like. So we at Kye Pot, effectively are a group savings-led neobank. And I'm sure that everyone on the call would have heard about neobank a lot. Even the previous presenters have presented, and there are a lot of fintechs who are called neobanks or calling themselves neobank, but effectively, banking is necessary, banks are not. So what it means is that the activity of savings or borrowing or investment, when it is conducted on the rails of a formal financial system or equivalent to that, without having that license or a banking license yourself, that typically can be called as a neobanking. So I sort of adapt that term, but India is still sort of taking on that different perspective of that term, and neobanking is becoming very hot in India. But we like to call ourselves a neobank for tier 2 and tier 3 India, which is actually social savings or group savings led. And so let's focus on India, because that's where we all are. So over 1 billion of population that we have, we have done very well in the last 5-6 years. So actually bank most of our citizens, and that has also been as a result of Jan Dhan, Aadhaar, mobile, everything that has happened in the last few years. And pretty much, this number might not be up to date, but might be sort of, maybe 6 months or 12 months older number. But more than 80% of India, the eligible population is actually banked. What it means is they have the bank accounts, or they have been forced to open the bank account because of the subsidies that need to be transferred electronically from the government to their bank account, which is something that India has done very well. But when we look at the traditional savings and the investments or usage of that bank account, on an aggregate level, 48% of these bank accounts are actually very, very inactive, which means that they are just being used to take the money out, that's it. So there is no habit of saving, investment that happens as a result of getting a bank account. And a little bit of macro perspective that, the asset classes that you and I are very familiar with, where everyone thinks most of the investments or saving happens, or the investment that happens, mutual funds, stocks, you all have heard. But if you look at, the population size of India and the penetration of these products or the usage of these products, not more than 2 to 3% of India actually invests in mutual fund. Similarly, in the stocks as well. And there, most of that activity actually is in a white collar environment, tier 1 environment, slightly middle to upper income environment. But when we look at the traditional informal group savings, chit funds, which is also known as, locally in many different formats, sort of more than 200 million people actually have use it in some form or the other. So which is, probably reaching up to 20% of the population. So which is very high. So this is staggering actually. When we look at very formal asset classes, investment asset classes, saving asset classes, the penetration is very, very low. But that also means that there's a huge opportunity to sort of increase the base. But here, when this sort of staggering numbers are being sort of done formally, informally, or actually everything is being done very informally and very, very manually. So this is what sort of got us excited, because this is where a lot of savings and investments happen in tier 2 and tier 3 India. And this is where a lot of inefficiencies are there. This is where a lot of digitalization that can happen. There's a lot of actually, things that can be streamlined and made better, faster, quicker, or the benefits can be provided to the customer in such a way that they already know this, they have done this, and the digital or the sort of streamlined activity can actually benefit the consumer in such a way to get rid of all the problems that exist out there with such a high usage. So I'll come to that as well. And um, there are a very huge variety of type of formally regulated institutions for savings, investments, borrowing, etc. And I'm happy to spend more time towards the Q&A on that one as well. But that itself is a huge that can be a 1 hour long presentation on really the spread of all the different types of institutions and the asset classes. So now I'll spend a little bit of time in actually going a little bit deeper on what group savings and borrowing chit funds are. So this is one of those unique bundled asset classes where the activity of saving and investment and borrowing happens from one single asset class. So what happens is that traditionally this activity happens when an aggregator or somebody locally pulls people together, forms a group, and everyone agrees to put in equal amount of money every month or every recurring duration and pool in the funds. And within the group, somebody who needs the money can actually take that money out through a process of reverse discounting or something called as auctions. So which means that 10 people get together, they all pool in sort of 10,000 rupees, 1 lakh rupees get pooled here, and out of the 10 people, somebody has a need of money, they can actually take out the pool. So for someone within the group, they've just put in 10,000 and they have the advantage of actually taking 1 lakh because they are in need of money to do something, as opposed to trying to take a loan from a formal institution or informally through friends and family or through a money lender or whatever that case is. So this is that unique asset class where all the three attributes are combined into one. So this is this is quite advantageous if the user of this asset class understands this very well. But on the other side, it is very different because this is not a pure investment asset class. This is not a pure saving asset class. What it means is that you can actually take out the money anytime during those 10 months, whenever you feel like or have a need, or you feel that the rate of taking the money out is fantastic. So there are advantages and disadvantages both, but the advantage is that it's a combined bundled asset class, but it is not a purely borrowing asset class. It is not a pure investment asset class, which means that it cannot be compared as a like for just with investment asset class. So moving ahead, this asset class is actually a formally regulated asset class in India with some complicated regulations. And it is also very, very predominantly used in an unregulated fashion, which is very informal, very local. But the common between the regulated and the unregulated activity is pretty much everything is done manually, offline. So that's one of the reasons when it is done manually and offline, you can't really scale it up. You can't standardize. If you can't digitalize it, you can't standardize it. If you can't standardize and digitalize, you can't really scale it properly. So which means that you will have to do everything offline and in manual fashion. So the formally regulated industry and the informally run industry actually aggregates around 30 lakh crores annually. And that is a very conservative estimate from all the research that has been done by various researchers. But it's a quite a tightly regulated industry. But there are quite complications around it, which is why there are lots of inefficiencies, there are lots of leakages, and we hear whenever you type chit funds on Google, you might you will come across, or you will come across with fraud, scams, and all these things. So uh, it is quite a large number, and this much volume of money that is flying around informally, that is staggering. So why not bring it to the formal formal system and actually give the advantages back to the customer and to the economy and to the to everyone connected to that. So 1/50th of this is actually taking place in a regulated format, and 70% of the regulated uh, industry is actually quite dominated by very large chit fund players, some of whom have been around for 10, 20, 30, 40 years. So these are literally, institutions. These are financial institutions. These are state-run institutions. So there are actually three players in this ecosystem. One is a customer like you and I, or those 200 million plus customers in India who are using this formally, informally. And then there are chit fund companies or the institutions. And that's what I say, there are some larger ones as well who have stood the test of the times. There are some that have matured and become multi-asset class institutions like the Shriram Group. Then there is Muthoot as well, Manapuram. All these started with chit funds. Yeah. A quick anecdote is that Karur Vaishya Bank, 35 years back, used to be a chit fund, and then eventually it got transitioned and became a bank. So this is the institution, and then there are regulators. So there are three important players in this ecosystem, which is again a parallel of any other financial services asset class. There are customers, there are institutions which are formally regulated, and there are regulators which regulate them to make sure that customers are protected, businesses are done as per the business practices and the laws mandated, so that there is everyone's interest is protected. But however, still the kind of financial frauds or the kind of issues that we see in India around this space is quite large. Having said that, there are other, the other kind of financial frauds, or the examples of the banks going under, the examples of frauds around the investments, asset classes, the mutual funds, the AMCs going down as well, is also something that we have heard. But if so, because I sort of look at this space very deeply, the number of formally regulated chit funds regulated by the government going bad is far less than the banks, formally regulated banks, going under. So most of the issues that we hear in the press is all about the informally run group savings, chit funds, species, committees, etc. And the regulations in this space is also multi-tiered, quite complicated, which also results in lots of issues as well, because it is the whole regulatory framework is enacted by Government of India through a parliamentary act, which is sort of instigated by Ministry of Finance. The institution, which is a chit fund, it's a special type of NBFC, which is through the charter of RBI. And the day-to-day regulation is through the state governments. It's a state subject, like the cooperative banks within the states through a registrar of credit. So imagine the complication around it, and effectively, the investor education or the consumer education suffers. And in our own experience, we have seen and heard from the customers that customers don't even understand this is a regulated asset class. and how complicatedly this is regulated. So there are lots of equivalent of, you know, investor protection, customer protection in terms of the tier one capital and regular filings that a chit fund company has to do, which is, you know, very similar to the deposit insurance that the banks have to provide on your deposit, controlled by the RBI. So happy to cover that in the Q&A if somebody wants to understand that more. So what effectively got really us excited is that it's a very large problem to solve. We're talking about 30 lakh crores in the informal system in Bharat. So can we actually bring it online? Can we actually formalize it? And can we actually do it in such a way? Can we connect that to the modern ecosystem in such a way that the customers, the institutions, and the regulators can take the benefit of it? So there's a lot to be done there. So I touched upon that the customer who is very familiar with this or knows this kind of activity is primarily a self-employed, a merchant, or a shopkeeper. And these are, India has 60 million plus MSMEs, and there are pockets of development happening in every space in fintech, trying to bring these MSMEs into the digital spectrum so that they can avail the payment services, they can avail lending, they can avail other services, and this is where India has a staggering sort of 300-400 billion liquidity gap or a capital gap for the MSMEs. The capital that the MSMEs need to run their business, to manage their business, or grow their business. So, historically, this MSME segment have always relied on informal ways of financing. And this asset class works very well for them. So, which is why I was sort of, laboring on the point that this is not a pure investment asset class. So the pure investment asset class, the people who get attracted to the pure investment asset class are mostly the salaried people, because they have a fixed income, they want to generate the returns, or they have to save their taxes, for which they can actually invest in multiple different types of asset classes through which they can get tax benefits from the government or from the tax department. But this MSME or a shopkeeper, Dandawala, he's all thinking about how can I rotate the cash? How can I get more money to buy more stock or actually, invest in my own family? How can I run my business? How can I buy some a vehicle for my family? How can I fund the education of my children? So they're always doing this from a business standpoint, running the business, growing the business. So they don't keep the money in their savings bank account or the current bank account. They put it in the dhanda. So they don't have any excitement of getting the returns by putting the money in the savings asset class or mutual funds or stocks. And they don't really know the mutual funds or the stock investment asset class and trust them. All they hear about is the stock scam 1992. What Mehta? Sorry, I'm forgetting the name. So, anyways, so for them, they've always sort of used this informal financial services as a method of rotating the cash and taking the money out, which is the chit funds, the committees, the BCs, etc. are. And they know that it works very well for them in terms of the borrowing as well. So in the group construct, when we look at all the flavors of the scenarios, whether it's a 12-month group, 24-month group, or the longer-term group, whatever the values are, the cost of borrowing from a group is always very, very lower for this customer or this particular MSME person compared to taking the same amount of money, either from a private money lender or a formal institution like an NBFC or an MFI and also they know the pains that they have to go through to get this kind of financing if they have to go to a formal institution. The formal banking institution will not even cater to this customer, MSME. Bring me 3 years of P&L, balance sheet, this, that. And most of these MSMEs are not even using bank accounts to collect their account receivables or money from the customers. So they don't have that digital footprint. They don't have that strong P&L. They don't have the balance sheet. So they use the informal avenues. They'll go to the family, money lender, or a chit fund, and see, oh, it's easier for me. But at the same time, they understand the value and the rate of interest. So whatever way you put it and compute, this product really offers them a very low cost of capital, sometimes much, much lower cost of capital. So this is what primarily the consumer of this asset class is. And because they don't have to save money to get tax returns or those kind of things, so that's why we sort of go and focus on the MSME customer segment, not the salaried customers. But it can also be sort of used by the salaried customers to get returns where you wait until the end and then take the money out. So so this is that asset class where it's like a equivalent of a crowdfunding. So what it means is that the money is collected by the people in the group, and somebody in that group takes the money out. So this system is not dependent on external borrowing, or this entity is not dependent on getting external borrowing from a bigger lender or a wholesale lender or a bank, which is what the business model of a retail or any lending institution is. So they have to procure the capital from somewhere at a cost and then lend at a cost and cover their margins. That's a business model of an NBFC. But here, this product takes the money from the people, and which is why this effectively is sort of always a counter-cyclical product. We go through peaks and troughs, good times and the bad times. So when we go through if you're going through a very good time, and there is a lot of liquidity available, in the market in terms of easy borrowing. So what we will see is there is a counter impact on the other side, on the savers, or people who want to park their money in some savings and the investment asset classes. And because we are talking about this MSME sector, if they have additional liquidity, they will not put their money in the savings bank account or the current bank account. They will still actually do this more. But if you're going through a bad time when there is a liquidity crunch, we see that the informal asset classes, start to be used more. So whether it's a good time or a bad time, that's the nature of this product. It will always be sort of in demand. So it doesn't really get affected by the cyclical economic, impacts, which is more easily felt in the formal financial system and the formal asset classes. So we see that there is a sort of good opportunity to sort of bring this online and connect it to the formal system, which is where a merchant can be provided additional services on the basis of what they do in this product on our platform. So what this tries to show us here is that again sort of explains that the typical MSME customer segment who may not have a great credit score or may not have a credit bureau score is always left out from the financial system, or left out by the financial system because of the stringent underwriting things that are put in place. So effectively what we see is that this under served segment has to borrow at a very high rate. So for people who have a great credit score, who have a decent salary, very regular salary, who are working in jobs, they can avail credit very easily, and the rate of borrowing for them is also quite low. So, but we have a huge unaddressed segment. As we go higher and higher, the risk becomes higher, the interest rates become higher and higher. So we typically see that it's a chicken and egg situation. If you're dealing with a customer segment who do not have a strong footprint in the bureau or cannot produce documents, then they will be given loans at a high rate, and the rates become higher and higher. And that's where we see that sort of the under served segment overlaps with the MSME customer segment, which is where we focus. Then one of the things which we really wanted to change and that got us excited was that because of the complete offline activity, manual activity, there were huge inefficiencies. We all have heard about all the large amount of money getting lost, leakages, etc., or the customers losing money. So that really sort of prompted us to sort of build a digital fintech or a platform in this space. And what we sort of ended up creating was a complete end-to-end neobank, which is at core on this, using this asset class. So our model is that we completely digital, we are branchless, as opposed to some of the institutions that you saw on the other slide, doing chit funds, very large, have been there for 30, 40 years. We look at a way to understand the customers, which is digitally, onboard them through the digital channels, and then let the tech do the work, let the platform do the work in terms of understanding the risk, understanding their needs. And we have made this pretty much a sort of a paperless process. Of course, there were lots of things that we had to do in terms of trying to work closely with the ecosystem to make that happen. But this thing which is done very much offline, for us, our way of operations is completely online on the mobile app. And we have a very sophisticated backend system with lots of channel integration, API integration, as well as at the core of it, it is like a personal finance management app, which tries to understand a customer's ability to save, invest, or borrow, or pay something every month, and uses the social algorithms or the alternate data to understand the intent and ability to pay or repay and get these customers into the right products. And of course, everything else that is we take for granted in terms of the user engagement, the payment collection, the disbursement, etc. Those things have to be digital, have to be online. So we sort of went down the route of actually looking at how can we do this without any offline, without any physical presence, without any sort of feet on the street, and do this very much digitally. So we had to sort of we had to sort of build a model where we could acquire the customers through online and through the channels or the partner channels, which is where these shopkeepers or the merchants actually reside. And that allows us to sort of reach out to them through a trusted source, through influencers, or we get the customers through them who are the influencers. And then our system and the algorithms, does the rest of the stuff. So this is where the majority of our life in Kye Pot is spent, where we sort of build, operate, and service the customer, which is very contrast to this 30 lakh crores that is being done offline in a very, very manual, human intervention kind of way. And that is what we have tried to sort of build on the app, where the customers get a delightful experience. Everything is real time. Everything is contextualized. Our tech and engagement, we let that do the work. And over the last 2.5 years, we have seen that the customers actually, as they start to sort of get some experience of a couple of months, start to trust the platform, and then they don't want to go anywhere. They come from a very offline usage of this kind of asset class, and then when they come here, they are sort of able to appreciate, as well as they're able to tell us that whatever they were experiencing, or the kind of bad experiences they had, this is completely a very contrast of it. So I think I've really come to an end of my sort of one-way presentation. And I'll Mansi, Sanjana, if you can sort of, open up for questions, or I'm sure there will be a lot of questions.
Yeah, Sid. So I think, again, to everyone, to all our participants, please do post any questions that you have after listening to Sid. I'm going to start off with the questions that we had, gathered at the time of registration. So Sid, you would have covered some of them, but, we can still just go over the questions so they are answered. So they said, what are your customer acquisition and delivery channels? And the regulatory details of P2P lending and chit funds, like what do you need for licenses and partners? So I think we can focus on the customer acquisitions and how do your delivery channels.
Sure. So as towards the end of the presentation, I was trying to sort of allude to, when we did this as a complete digital offering, we said that we will not do anything which is offline, which is not like the traditional chit funds. So the only method or the only source of onboarding the customers is actually through the online mobile app. And the way we actually get the customers in is through a couple of ways. One is customers discover us, or primarily the customers refer their friends, family, and their contacts through a peer-to-peer social referral or the influencer-based referral model. And the same model is something that we have applied to our channels, and these are our B2B channels. So these are communities of merchants that are the customers of our partner channels, where they are using some other form of financial services or doing something else as a livelihood, but in a digital format on somebody else's platform. And we go and partner with them, and we offer our product as a single touch to those customers on the other platforms. So literally like an embedded finance approach. So these are the two main methods, or the channel acquisition, or the channels for us. And the second part of the question was around the regulations, right?
Yeah.
So I covered the regulations to an extent in the presentation. So this is a fairly tightly regulated asset class, which is, I would say, overly regulated by too many regulators, which is also sometimes the cause of confusion and the problems. And I would say also results in the ineffective law enforcement. So if it's regulated by the central regulator or central government of India through the National Act, and then regulated by the state governments on a day-to-day basis. Was there a additional part to this question?
No, so I think that
I think you asked about the peer-to-peer, I think, right?
Yeah, the P2P lending, the regulatory details for P2P and chit funds, license and
so these are two entirely different asset classes as per the regulatory framework of India. So P2P NBFCs are regulated by RBI, and P2P regulatory framework has a concept of borrower and saver. So what it means is that the saver is an investor, and they are only investing, and there is a borrower who can come on the platform, and this platform is to intermediate with some level of risk management done or the matching done. And
Correct.
it's a very special type of NBFC license. And there again, the platforms are allowed to take fees. They are not allowed to lend directly from their own books. They also cannot give 100% guarantee to the investor that their capital is safe. Chit funds, on the other hand, as I described, is regulated by different set of regulators, and it is very much in a group. So the same saver becomes the borrower, and the saving and borrowing rotates in the group.
Yeah.
And of course, it's regulated by different institutions. And here, the institution is 100% guaranteeing the funds back. The capital is safe. So, which is why the institution is allowed to take a commission every month for their services. But it is typically like a bank, and they have an equivalent of banking type of regulation, which is around rating for tier one capital, safety of the funds, and everything has to be done in such a way that these funds that are collected cannot be invested anywhere. They are only lent back to the same people in the group. So there are certain boundaries of operations there. And I think you can see a question popping up,
Yeah.
which
So,
is
so I think one we have is, what kind of losses does Kye Pot face, considering that they are only borrowing from their own chit fund. So what are the kind of losses that you would face, like as a company?
so for us as at a portfolio level, we have so this asset class or this type of institution has on an aggregate level much lower NPAs compared to an NBFC or a bank. And there is a structural reason for it. And that structural reason is that not everyone borrows at the same time. People are putting in money, and then they are taking the money, and then they have to repay back the remaining. So there is a different level of risk management that happens. So on a portfolio level, we run at a sub 1% decimal not in terms of the NPAs. Because we can't, we don't have an external balance sheet. So we have to be very conscious about our underwriting and customer selection.
Yeah.
So we run it on a conservative level as well. And then the other reason is that we're actually taking money from the customers as depositors. So we have to protect that. So we are very tight on that one. But on another challenge to that is that we have to scale in a manner which is sort of related to how much can we underwrite and collect in a safe fashion.
Makes sense. Yeah. So, Sid, I think a couple other questions. I think thanks. I think that explains the losses. An actually interesting question. The other question is, I think the general profile of borrowers. Like, I think there were. I'm just merging a couple people who've asked. But what is the profile? Is it only MSMEs? Is it only? Is it can individuals do it too? And is it primarily also driven for tech savvy millennials? So, what is the profile of your borrowers and lenders?
Okay. So yes. So we don't sort of restrict anyone coming onto the platform because it's online. So we have, a lot of our early adopters have been sort of younger people, millennials, who have heard of chit funds from a second degree. Maybe their parents doing it, someone in the neighborhood doing it, or their extended community doing it. So they're very much welcome. They come in. But the way this asset class works is that whenever a younger millennial salaried individual is coming in, they have other choices amongst which they compare what the rate of return that I can get in this saving or investment. So we focus very emphatically on education. And the way the product works, this product cannot actually provide you a very clear, single return rate, because it's the product works in a gamified fashion. Every month there will be an auction, and there will be people competing to borrow money. Somebody who is willing to forego more in the reverse auction will get the funds. So, which means the money that is left on the table is actually distributed amongst everyone in the form of dividend. So, this cycle repeats. So, here, this asset class structurally and legally cannot provide a confirmed rate of return, and that is the regulatory perspective as well. So, which means that it is open for people to manage it in terms of whatever their rate that they want to take the money. And when we look at the salaried individuals, younger millennials, they are quite excited with what they experience here, but they are looking at other choices, and they want to be very sure about the rate of return. Here, the rate of return sometimes can be as high as 25-30%, but it fluctuates with the way the performance goes, and it is up to the group to manage
it.
Which
But
is why we sort of uh, we have sort of always focused more on the MSME customer segment, who are very keen to use this asset class as much as of saving, but more than that for borrowing, because they can take the money out and they don't care about what return I'm getting by waiting for 12 months. They can take the money out at the lowest cost of capital, and this is 80% of the offline chit funds usage happens through these MSMEs, these self-employed, that kind of persona. So
I think that's also
uh,
because they need working capital. I think that's their biggest need, and where they struggle to get it from other institutions. So I think working capital, and that's why MSMEs become more, more likely to get into chit funds for borrowing.
Indeed. So there's a structural, there's a cultural, and there is a combining the two together. There are some legal restrictions in which you can run. So anyone, so again, uh, anyone who is promising a fixed rate of return and very high rate of return, especially using the chit fund name, run away from that.
So Sid, from the again, I had another question, so I'm just bringing that. So, from the perspective of a student, if they had to sign up on a chit fund, they would they, because they come online, like from digital channel directly, they came to know about it, they sign into your app and they do it. Would they get like a lower credit? Like, what are the points that you would use to underwrite them? Since they are not coming through, your network of MSME or through referral, would they have a lower credit score?
So our onboarding and our underwriting incorporates the algorithms in the AI domain, which is influenced by the social networks and the influencer, whether it's an MSME or whether it's any individual who is coming onto the platform. So the scoring for us and then allocation of the product is based on those criteria. And what it means is that somebody who wants a 20K per month product has the ability and may or may not be good in terms of the future payment. So may get accepted or may get rejected for that particular product. But if the relevant data points that we use from the social networks, from the algorithms and the influencers, so there is more likelihood that somebody will definitely get an approval, and probably approval for what they are looking for, if they actually come from an influencer network referred by someone.
Okay. All right. So I think that covers the questions. I see that there was one. I'm just flipping between Q&A and chat. So give me a second. I think we covered the losses. We have covered the credit. Is there an assessment of credibility for the customer? I think you covered that right now. I think we've covered all the questions. Yeah. Sanjana, am I missing any questions?
Mansi. We've covered all the questions, the questionnaire as well as the Q&A and chat questions. Yeah.
Yeah, and I think the digital technology, we had Sharmila asking about what digital technology is used to onboard the customer. I think we know that we use the app that is used, and they have a portal that is used to onboard customers. Um, so yeah, I think we have covered. So thank you so much, Sid. This was very interesting. I think for students to enlighten, for us to know about the whole chit fund model, and then especially how Kye Pot does it. So this is an area of interest of the students, and we thank you for your time today to run the session. Thank you to all the students and participants who attended. We hope you found this session useful. We do have a recording of this, and we will share the link for that on the MFH website. Let us know if you have any suggestions for future sessions, what you would like to learn about, hear about. Do let us know. And thank you so much. Thank you again, Sid, for your time.
Great. Thank you, Mansi. And happy to, if some of the questions were not answered, I'm happy to take them offline as well on email. Yeah, so I'm definitely happy to take those.
Yeah, we'll share them across to you. Thank you so much. And
Great.
Happy New Year, happy holidays to everyone.
Yes, thank you. Yeah, everyone. So happy New Year, and hope 2021 brings good things for all of us.
I know.
Yeah.
We end to a really different year. All right. Thanks.
All right.
Bye.
Thank you. Bye-bye.
Thank you.